So thank you for coming to this presentation. Just a quick brag about Jack. He's done quite a lot of work that blends mathematics and economics. 2 AIM projects in the summer. He also had an internship at CAA and an internship at APL. He's also the chairman of the Cadet Investment Group. So this is a nice capstone. If you came in late, yes, this is not about shampoo. Thank you for stealing my joke. But this is a joint work between Jack, he did 99% of it, myself, and Colonel Smith. So take it away, Jack.
Thank you, Colonel Siemers. Thanks everybody for coming out. I'm going to present my honors thesis to you guys today. My advisors for it were Colonel Siemers of the Math Department and Lieutenant Colonel Smith of the Economics and Business Department. Our project is titled An Algorithm for Investigating the Efficacy of Head and Shoulders and Inverse Head and Shoulders in Commodity Price Data. So to start things out, I want to give a little bit of background of a few topics just so that the context is explained a little bit for why we decided to do this project. So I'll do a brief introduction into what technical analysis is, what charting patterns are, specifically head and shoulders and inverse head and shoulders, a little bit about commodities as well. So technical analysis is an approach to financial investing. It's generally considered to be the exact opposite of what people call fundamental analysis. Technical analysts will look at the trading price history of a certain security, and also the volume history as well, which is just the frequency of trades. Technical analysts don't look any further beyond the actual trading price itself because they believe that any other factors that a fundamental analyst would look into, like global supply and demand and political influences, will already be factored into the price of that security anyway, so there's no need to look any further than that. So they'll search for certain indications or patterns within that price history to try to give them an idea of how they should invest. For example, a classic indicator is when the 20-day moving average of the price is above the 50-day moving average of the price, that means the stock or whatever security it is now has some momentum and it would be a good time to buy it. On the other hand, patterns are also really popular and they're known formations that are usually found by visual inspection. So charting patterns are what are referred to as those patterns that appear within a price history. There's a set of, let's say, maybe 20 known charting patterns that people look for, and chartists, the technical analysts who look for these things, they look for them because each one is supposed to indicate some certain event that will either be a good time to buy or sell that security. So let's say a chartist is just looking at his computer screen at Apple's price history data. So he'll be watching this in real time, waiting for one of these patterns to occur. And when he sees that, then he knows, okay, now I want to buy it or I want to sell it. But this is incredibly, incredibly subjective. It's entirely reliant upon the opinion of that specific chartist. And while one person might look at this price history and say, this is pattern X, I'm going to buy it, another chartist might say, I don't think a pattern's here at all. And they'll look for these patterns among varying sizes, which may be like 15 to 120 days. So head and shoulders formations are one of these charting patterns. It's defined as a series of 5 sequential extrema, or maxes or mins, that have the general formation as below, where the head is the middle maximum and is above the 2 outer maximums, which are referred to as the left and right shoulders, which are supposed to be relatively level. And then the 2 minimum are the left and right neck points, and again, are supposed to be relatively level. The line drawn through those is referred to by chartists as the neckline. So this pattern is supposed to indicate a good time to sell a security. And the reason for that is it indicates a trend reversal from an uptrend or a series of gradually increasing prices to a downtrend or a series of gradually decreasing prices. The reason why it indicates this is because the right shoulder is the point at which the uptrend is violated. The right shoulder falls below that trend, and so the momentum of the stock is now broken. Chartists will look at this and say, I think the price is now going to start going down. The inverse head and shoulders is the exact opposite of a head and shoulders formation. It has the same proportions and everything, but rather than indicating a good time to sell that security, it indicates a good time to buy it because the momentum now changes from decreasing price to increasing price. So what do I exactly mean by which one is a successful formation and which one isn't? So this is an example of a head and shoulders formation, these 5 extrema here. What happens is a chartist will be watching this price history, and at this point right here, boom, that pattern is identified. That chartist now says, okay, I think the price is now going to start going down because the trend reversed, so I'm going to sell this security. But the question remains, is the price actually going to go down or not? If the price keeps going up, then the formation failed. If the price goes down as it was supposed to indicate, then it passed. Exactly the reverse is true or expected for the inverse head and shoulders formation. So commodities are the specific security that we were looking at in this project. Previous studies that tried to do similar things only looked at common stocks or currency exchange rates. So that's a little twist on this study. Commodities are defined as inputs in the productions of other goods and services. They can be anything. Oil is a classic example, gold, cattle, coffee, you name it. And the price of commodities is determined by the fluctuations in supply and demand. So okay, with all that background information, now the reason why we decided to do this project. So the fact that these things are visually identified by chartists means that gathering the data points to figure out whether or not these things are successful is really, really hard to do. It takes so much time if we were to ask a chartist to sit down and gather 1,000 examples of when these things occurred. So it would be really useful if we could have a better way to do this. Meanwhile, there's a huge rising interest in data-driven approaches to financial investing. The whole demographic of Wall Street now is moving away from paper and pen trading tickets on the floor of the stock exchange to computers in back rooms, processing and generating trades without a human needing to be in the loop at all. So the question is, how can we actually get a computer to do what these chartists are doing visually, which is very hard to do because formations that actually occur in price histories are a lot more noisy than those simplified depictions that I just showed you. Here's an example of what one chartist decided was a head and shoulders formation. And I told you they're defined as a series of 5 sequential extrema, but there are a lot of other extrema involved in this specific formation. But nevertheless, it was considered an actual head and shoulders formation. So how do we get a computer to do this accurately? So onto our approach. Our methodology, we decided just to focus on the head and shoulders and inverse head and shoulders rather than the rest of those 20. First, just to narrow the scope of this project, and then also because they are the most popular and deemed to be the most successful. So that's why we're interested in these. And then to automate the recognition of these, we chose to create a function in MATLAB, which is a programming software that's typically used by applied mathematicians, engineers, really anybody. It's a great tool. And in order to get MATLAB to automate this process, we needed to define parameters, put these formations in terms that a computer can understand, compare those to an ideal so we know how good each of these formations are, develop a process for getting the computer to actually recognize if the data is in an uptrend or a downtrend, which still is not very easy. And then finally, once we know what the trends are and we know where the locations of those patterns are, then we can answer the question, was a given pattern successful in predicting trend reversal? So the data we used were the price histories from 17 different commodities and displayed in this table here. The data ranged from 1980 to 2013. We had to shorten some of the commodities due to availability, but nevertheless, we had a lot of data to work with, a lot of instances where we could find these formations. So our model incorporated 4 general parts. First, the smoothing algorithm, which tries to figure out what are those visually significant extrema and which are the ones that our eye glosses over naturally. Requirements for the pattern recognition. How do we tell that computer what it should look for in those visually significant extrema? The comparison of the identified formation to an ideal, so we know how good each one of these are. And finally, the trend recognition process. So our smoothing algorithm is, again, trying to achieve that visually significant extrema identification. And we use 2 parts to this smoothing. First is a simple smoothing function, which is the initial noise reduction and uses one parameter, which we refer to as the smoothing level. Secondly, we developed an algorithm that would further eliminate some of the extrema that made it through that initial smoothing function. The reason why we did this was because previous studies who tried to automate this process, they all warned that they thought the fact that they used just a smoothing function was leading to them over smoothing the data too much. And so even the patterns that they were recognizing may not be visually representative of the patterns that are actually happening in the real data. So what's the point, after you do that? So this project, in a way, is also a response to that request. And we use two parameters within this algorithm, which we refer to as the window and the tolerance. So our smoothing function is a built-in function within MATLAB itself. It's a weighted linear least squares regression, which is just a really complicated name for a function that uses a certain amount of data surrounding a point to average it out. That amount of data, those number of days, are what we refer to as the smoothing level. And this is really beneficial for our purposes because it's weighted. It gives higher weight to the data closely surrounding a point versus further away, so that helps with preventing over smoothing the data. So we run this smoothing function on the raw commodity data, and it will output for us a list of potential extrema that then we want the algorithm to actually cycle through and start to consider. So our algorithm will now sequentially go through each one of those points that made it through the smoothing function. And at each point, we test to determine if the price of each extremum is actually different enough for it to be visually significant. Our window are what we define as the number of days surrounding an extremum that we want to consider. And the tolerance is some percentage of the standard deviation across that window that the difference in price between two sequential relative extrema must exceed for us to say, okay, that's visually significant. So at each point, we're constantly asking, is the difference in price here enough so that it violates the tolerance, so that it's visually significant? So to illustrate this process, here's a very simplified example of a subset of data, in this case 15 days of smooth data that may have come out of the function. So in this case, there were 5 potential extrema that were identified, and our algorithm is going to cycle through them and try to figure out, okay, which one of these actually matter. So it starts off by considering point 1, and it'll ask, does the difference in price between point 1 and 2 violate the tolerance? As in, is it so small that it's not significant anymore? In this case, no, because it's a pretty large price differential. So we decide that point 1 is visually significant, and we move on to consider point 2. Now we ask the question, does the difference in price between point 2 and point 3 violate the tolerance? In this case, the price difference is so small compared to the standard deviation across that window that we think it's not significant, so we decide to average them out. Now we consider that average point and ask, is the difference between that point and 4 significantly different? In this case, yes. But before moving on, we have to do an additional check to see whether or not that point is still a relative extremum compared to the points surrounding it 1 and 4. In this case, it's neither a max or a min anymore, it's a point on the line, so we decided to delete it. So after our algorithm has gone through this subsection, it finds that points 2 and 3 weren't really significant relative to the larger scale. So it smooths those out and just says that 1, 4, and 5 are visually significant. But that was entirely dependent on this specific window and this specific tolerance. So what if we changed it? What if we had the exact same subsection, but now our window is 4 times the size and we have a lot of other points to consider as well? Well, the standard deviation across this window now is much greater than that smaller window. And so our tolerance is now much greater than it was across that smaller window. So our algorithm will now cycle through all these points again and ask the same questions to figure out which one are significant. At the end of that process, it'll find only points 1, 12, 19, and 26, and no longer points 4 and 5 as being visually significant, even though they were considered significant over that smaller range. So what's the point of me showing you this? So this means that by varying those 3 smoothing parameters, by varying the smoothing level, the tolerance, and the window, we can try to recognize patterns of different sizes, because by choosing larger values of those smoothing parameters, we look at larger patterns because the visually significant extrema will be more spread out. But at the same time, we're still interested in finding those small patterns just as much as we are in finding the large patterns. We just don't necessarily have to find them at the exact same time. So in order to compensate for that, or utilize that, we have our MATLAB function loop through many, many iterations of these parameters to try to find those patterns of differing sizes. And once we're done with looping through one specific set of parameters, and we output our list of what the visually significant extrema are relative to those parameters, then we can look at each one of those and see, are there any 5 sequential extrema in that list that meet the qualifications of what we would think a formation is. But again, now we have to convert that into what a computer can understand. So we need to parameterize the explanation that I gave earlier about what a head and shoulders formation actually is. We define it as this: a set of 5 sequential extrema, E1 through E5, that meet the following specifications: E1, E3, and E5, aka the 2 shoulders and the head are relative maxima. E2 and E4, the neck points are minima. The head, E3, is taller than both of the shoulders. Each of the shoulder points are taller than their respective neck points. And in these 2 formulas here, both the shoulder points and the neck points need to be relatively level within some percentage of error. And in this case, we used 4% error, which was backed up by some of the previous studies. And finally, a head and shoulders formation has to occur following an uptrend. That's necessary to test to make sure that it reverses to a downtrend. Inverse head and shoulders, the exact opposite of that, where E1, E3, E5, the head and shoulder points are now minimums. E2 and E4, the neck points are maximums. And then again, we need to have the shoulders and the neck points be within a certain percentage of error. This time it must occur following a downtrend. Okay, so now we've looped through all of the data. We've found which points are visually significant. We've parameterized how we want to search through those significant points to find if a formation actually occurred. Now we want to ask the question, in each one of those formations that we identified, how good is it actually? And that helps us with 2 things. Number one, we can figure out at what point is a formation that we identified still not really visually representative of what a chartist would think a formation is. And number 2, it'd be pretty interesting to look into what's the performance difference between what we see to be good formations or proportionate formations and bad formations or ones that are really crooked. So to do this, we developed the ideal proportions of what we thought were the perfect possible proportions of what a formation could be, using 2 terms: the X scale, or the difference between the left and right shoulders, and the Y scale, or the difference between the head and the average of the 2 neck points. And we said that each one of those 5 extrema on the difference in X value needs to be 1/4 of the X scale. In other words, they need to be perfectly distributed across. The difference between the head and the neck points should be 1/3 of the Y scale, and the difference between the shoulders and the neck points should be 2/3 of the Y scale. And those numbers are not just what we thought to be, visually representative, but also is backed up by some of the previous literature as well. So by using these ideal proportions, we can then take what we saw as our 5 actual identified points and scale them down to the ideal. Since these formations are all of different sizes, we need some way to compare them all in the same way. So by scaling it down, we can have an accurate comparison between how good is a pattern that occurs over 15 days compared to one that occurs over 120 days. So to do this, we calculate an error term, the mean squared percent error, percent being key, which we calculate between each one of the 5 actual and ideal extreme point, where mean squared percent error is defined as the summation between the summation of I equals 1 to 5 of EIX, or the absolute difference in X value between EI, the actual extreme point, and II, the ideal extreme point, and EIY, or the absolute difference in Y value between EI, the actual point, and II, the ideal point. So this graph here is supposed to kind of illustrate that a little bit. So essentially what our error term is we take our 5 ideal proportions in the red circles, we scale down the blue stars, our actual identified proportions, we figure out what the difference in X and Y values between each of those are, square it, and add all 5 together, and that's our mean squared percent error. So after looking at all our initial results and looking at what this error value was giving us, we found that the answer to that question, when are these not representative of the formation anymore, happened at about the line of a mean squared percent error of 0.8. So the ones that had less error than that were included with our results, and we said these are the ones that a chartist would actually pick out. And the ones that are greater than that, we said the parameterization that we made was too general for the ones greater than this, so we're not going to consider them any further. Okay, so now we have the locations of our charting patterns. So, and now we need to see whether or not the trend actually reversed or not. But unfortunately, this is still not a very easy question to answer, because just as the charting patterns are very subjective, trend lines are very subjective also, and are usually just picked out visually by chartists. So to try to account for that, we took a very dynamic approach to recognizing them. So we had the computer go through many, many iterations of simple linear regressions through, if we were looking for an uptrend, the relative minimums in a window, and if we were looking for a downtrend, the relative maximums across that window. And rather than telling a computer, restricting it and saying, if you have a formation of 30 days, you have to run a regression through the data that happened 60 days prior to that, we give it a range, a window to look through and say, run a bunch of different linear regressions through this window and try to figure out which one is the best linear regression, which one minimizes the R-squared value or the goodness of fit. And in that way, we can figure out what the most well-defined trend was across that window, and we would prefer longer trends as well. So here's a quick illustration of this. So let's say that we had some price history that starts to go into a general uptrend, and then bang, a head and shoulders formation occurs. So okay, now we know we want to try to figure out what the defined uptrend was leading into this formation. So to do this, we'll start by telling the computer, all right, run a linear regression through the preceding 3 minimums. Record your R-squared value, how good of a fit that is, record the slope. Then add an additional minimum, run another regression, record what the goodness of fit is and what the slope is, add another one and another one. And at this 6th minimum, finally we get to a point where the goodness of fit is decreasing because the uptrend starts to flatten out a little bit. So this is the point at which that trend is less well defined. Once the computer can recognize this, then it knows it wants to go back to where it was most clearly defined, where the R-squared value was maximized. So the regression through the preceding 5 minimums is what is accepted as the uptrend leading into this formation. And we can do the exact same process, but instead forward-looking after this formation to try to figure out if it was an uptrend or a downtrend and for how long that trend occurred. So on to our results. So here are 2 examples of outputs of our actual function, and in this case they were both successful. On the left is an example of a head and shoulders formation that was found in Unleaded's historical data, and on the right is inverse head and shoulders in commodities historical price data. So the blue lines here are the raw data, that's the actual prices at which these commodities were traded. The green lines are the smooth data points that came out of our smoothing function. The pink lines are what were recognized as the best trends across that window that were, again, dynamically created by that process that I just went through. The red stars are the actual formation extremum that made it through both our smoothing algorithm and then the parameterization of what constitutes a pattern. And the black triangles are those ideal formation proportions scaled down to the respective scales. But not every single formation passed. It wasn't 100% accuracy. So here are 2 examples of when these formations actually failed. In this case, in aluminum and cattle data. So here, again, we have an uptrend, a good 5-point formation. At this point, it's considered a head and shoulders formation, but there's no trend reversal. The trend continued, so in this case, that failed. The exact same, but for continuing a downtrend for the inverse head and shoulders on the right. But we had a bunch of these to look through, and rather than do manual data entry and to be able to use a cool tool here, we also developed a graphic user interface within MATLAB itself that we could use as a command center of sorts for running all of our functions, which then after we wrote them, we didn't have to open them back up again. If we wanted to do our data processing we could just use this instead. And in this GUI, we could define if we wanted to look for head and shoulders or inverse head and shoulders pattern, what commodity we wanted to look at, the smoothing parameter values that we wanted to loop through, and just to illustrate how fast this is in comparison to someone doing this visually, we looped through 400 different combinations of these parameters, and for each commodity it only took about 20 minutes. So we could basically just choose what we wanted to look at, press play on this, and then a user, most of the time just us, could then review what the results were. And that was effective, one, because then we could start to modify our functions and make sure they're working correctly, and two, rather than just blindly accepting the results it gave us, we could actually see what was actually going on in the data. But with that being said, it's not necessary to produce the results. It's still 100% automated, but we allowed the opportunity to put a human in the loop just in case and to see how well this is performing. So at the end of the day, after looking through all of our data, we found that there were 308 head and shoulders formations and 293 inverse head and shoulders formations. The head and shoulders were successful 57% of the time, and the inverse head and shoulders were successful predicting that trend reversal 61% of the time. So what does this mean? Well, first off, in the previous literature, they also found around 60% of the time that these formations were successful. So that was encouraging, at least, that it was backed up by previous studies. Success rates greater than 50%. Well, these things aren't awesome, and it may sound discouraging that you're only about 60% of the time going to be right. If you implement this into a trading strategy over time, the fact that you're making money over half of the time means that you will make a profit in the long run. So if someone can figure out a good way to define where exactly after that formation occurs, should you implement your buy or sell signal, when you should make your trade, and when you should make your exit, which is probably the harder part, you could make money off of these things. But we decided to look a little bit further into these things, into our results. We ran some rank sum hypothesis tests, which are tests for difference of mean, to try to figure out, do any of the following parameters have any sort of impact on the performance of these patterns. Specifically, we were interested in mean squared percent error. So we thought probably the formations that have lower mean squared percent error, those that are closer to what we would expect the formation to look like, will probably have higher success rates versus the ones that were really crooked and not formed well. Second, the relative length of the back trend line. So we thought, okay, maybe the formations that occur after a really long and well-defined trend, if the formation is the start of that violation, maybe it's going to have a better chance of withstanding that violation versus one that's in a very short trend and it's already a kind of volatile commodity and it's maybe less predictable. And then also formation length. Is there some kind of natural variation in